The dollar is our currency, but it's your problem. John Connolly, US Treasury Secretary, 1971. In the kingdom of the blind, the one-eyed man is king. Desiderius Erasmus, 1500.
So, what would actually happen if the United States defaulted on its debt? Not in vague economic terms, not in abstract percentages, but in real life, hour by hour, day by day. What does it actually look like? That's what we're going to break down today. To understand what a default really means, you first need to understand the situation the US is already in. Right now, the United States is carrying a national debt of over $38.5 trillion. Some estimates put it slightly higher depending on what you count. Either way, it is a number so large that the human brain genuinely struggles to process it. Here's one way to think about it. If you spent $1 every single second of every single day, it would take you over 31,000 years to spend $1 trillion. The US owes 38 times that, and every single year, the government has to pay interest on that debt. Right now, that interest bill alone exceeds $1 trillion annually. That's more than the entire US defense budget, more than Medicare. The US is spending more on interest payments than on almost anything else. So where does the crisis come from? There's a mechanism called the debt ceiling, a legal cap on how much the government is allowed to borrow. Congress has to vote to raise it. And in recent years, that vote has become a political weapon. Democrats use it. Republicans use it. Everyone threatens everyone else. The deadline creeps closer. Markets get nervous. And at the last possible moment, some deal gets struck and the ceiling gets raised. It has happened every single time in American history. But markets aren't worried about history. They're worried about what happens if the pattern breaks. What happens if one day the US simply can't pay? It's 6 a.m. New York time. Asian markets have been open for hours. The news broke at around 4 a.m. Eastern. A Treasury payment was missed, not delayed. Not under review, missed. Tokyo drops 2% before most Americans are even awake. Hong Kong follows within minutes. Singapore, Seoul. The selling is fast, mechanical, almost automatic. Because in moments like this, institutional investors don't think, they execute pre-written contingency plans. By the time London opens, European markets are already in free fall. Frankfurt, Paris, Milan, every index in the red, and not slightly red, the kind of red that makes experienced traders go quiet. Then New York opens. The Dow Jones falls 500 points in the first hour, then another 300. Circuit breakers, automatic trading halts designed to slow panic selling, trigger for the first time in years. Why is it this bad? Because US Treasury bonds aren't just investments, they are the foundation of the entire global financial system. For decades, when countries, banks, pension funds, and corporations wanted the safest place to store money, they bought US Treasuries, not because they loved America necessarily, but because American debt was considered functionally risk-free. The US always paid, always, without exception. That belief, that certainty it's us, is the bedrock under everything else. And today, for the first time, that bedrock has a crack in it. Investors don't wait to see if the crack grows. They move immediately into things they trust. Gold, Swiss francs, Japanese yen, physical cash. Gold jumps 3% in a single session, the kind of move that normally takes months. Treasury yields, and the interest rate the US has to pay to borrow money, spike hard. Because now, anyone still willing to lend to the US wants extra compensation for the risk they're taking. For the first time in history, the safest asset in the world is no longer safe. And when that changes, everything built on top of it starts to shake. By day 3, it's not just about stock prices anymore. The damage starts moving into the actual infrastructure of finance, the pipes and wiring that most people never see, but that every economy depends on to function. Here's something most people don't think about. Banks don't hold all of their assets in cash. They invest. And a massive portion of those investments for banks around the world are US Treasury bonds. Safe, liquid, reliable, or at least they used to be. When treasuries lose value and trust simultaneously, banks face what's called a liquidity crunch. They don't have enough accessible cash to meet their obligations. They start borrowing from each other at emergency rates. Some smaller institutions can't get what they need at any rate. Meanwhile, something called money market funds starts making headlines. Money market funds are where millions of ordinary people park savings they want to keep safe but accessible. Corporations use them for operating cash. They're supposed to be the most boring, stable products in finance. A dollar in, a dollar out, always. When the assets those funds hold, including treasuries, start losing value, the fund itself can fall below $1 per share. This is called breaking the buck. The last time it happened was 2008. And it triggered such immediate panic that the government had to guarantee all money market funds within 48 hours just to stop a full-scale run. Now imagine that happening against a backdrop where the government itself is the source of the problem. And then there's what happens to borrowing costs across the entire economy. Mortgage rates jump because everything in the mortgage market is priced relative to Treasury yields, and those yields just spiked. Anyone trying to buy a house this week suddenly can't afford what they could afford last week. Business loans get more expensive. Companies that were planning to expand start postponing. Hiring freezes. Some cut jobs preemptively. Credit card rates rise. Consumer spending pulls back. Each of these effects feeds the others. Less spending means less revenue for businesses. Less revenue means more cost cutting. More cost cutting means more unemployment. More unemployment means even less spending. You can feel the recession forming in real time, like watching storm clouds gather on a clear day. And all of this from a default that the government could, in theory, resolve in a matter of days. The problem is that the financial damage from even a brief default doesn't reverse when the default ends. The doubt lingers, and in markets, doubt is almost as destructive as the event itself. Here's where it goes from an American crisis to a global one. The US dollar is the world's reserve currency. This sounds like an abstract title, but it has enormous practical consequences. When Nigeria buys oil from Saudi Arabia, the transaction is almost certainly priced in dollars. When South Korea buys semiconductors from Taiwan, dollars. When Brazil pays for imported machinery, dollars. The whole architecture of global trade runs on the dollar, and it's backed, ultimately, by confidence in American debt. So, when that confidence breaks, the shockwave doesn't stop at the US border. Take Japan. Japan is the single largest foreign holder of US Treasury bonds, over $1 trillion, held by its pension funds, insurance companies, and central bank. Japanese retirees, in a very real sense, have their savings tied to the assumption that the US always pays. When the default hits, Japanese institutions face immediate losses. The yen spikes as investors rush capital back home. Japanese officials are on the phone with Washington within hours, demanding answers, getting none. The political fallout is severe because Japanese governments have staked enormous credibility on the safety of American debt. Then there's China. China holds somewhere between $700 and $900 billion in treasuries. For years, geopolitical analysts have speculated about whether China might use this as a financial weapon against the US, threatening to dump treasuries if tensions escalated. In a default scenario, they don't need to threaten. The damage is already unfolding. But if China, or any large holder, decides to start selling its treasury holdings, it accelerates the spiral. More supply flooding an already panicked market drives prices lower and yields higher, making the crisis worse for everyone, including China. Europe faces the crisis through multiple channels at once. European banks hold dollar-denominated assets. European pension funds own treasuries. European exporters sell to American consumers who are now watching their spending. The interconnection is so deep that there is no clean way for Europe to simply step aside from an American default. And in emerging markets, Brazil, India, Turkey, Indonesia, dozens of others, the consequences can be outright catastrophic. Many of these countries have taken on dollar-denominated debt of their own. When the dollar becomes unstable and global investors panic, capital flees from emerging markets first and fastest. Currencies collapse. Borrowing costs explode. Countries that had nothing to do with American politics suddenly find themselves in economic crises. It's a domino effect that circles the entire globe. The United States sneezes, and half the world reaches for a thermometer. And the bitter irony is that the countries most exposed are the ones that trusted America the most, and that bought the most treasuries that aligned their economies most closely to the dollar system. Now we get to the question that goes beyond markets and recessions, the question about what kind of world comes after. The dollar's power isn't just economic, it's psychological. It rests on a belief, deep, global, almost unconscious, that the United States is the one country that will always, without question, honor its financial obligations. That America's word in financial terms is as good as gold. A default doesn't just cost money, it kills that belief. And beliefs, once killed, are very hard to resurrect. The question then becomes, what fills the space? The euro? It's a serious currency, but the Eurozone doesn't have a unified bond market. There's no single European treasury issuing truly safe, deeply liquid European debt. German bonds are safe, but limited in supply. The infrastructure isn't there. The Chinese yuan? China has been pushing hard for yuan internationalization. But there's a fundamental problem. China controls capital flows in and out of the country. For a currency to function as a global reserve, the world needs to be able to buy, sell, and hold it freely. China hasn't allowed that, deliberately, because full capital openness comes with risks China's government isn't willing to accept. Gold? Central banks have actually been buying gold at the fastest rate in decades. Russia, China, India, Turkey, all quietly diversifying away from dollar reserves into physical gold. A default would accelerate this trend sharply. But gold is finite, immobile, and genuinely impractical as the foundation of modern global trade. The world moved away from gold for good reasons in the 20th century. Digital currencies, Bitcoin, stablecoins, central bank digital currencies all get mentioned. But none of them have the institutional depth, legal framework, regulatory clarity, or sheer scale to replace a system built over 80 years. What about the BRICS bloc? Brazil, Russia, India, China, South Africa, and now several other countries that have joined, have been openly discussing alternatives to dollar dominance for years. A US default would give that conversation explosive new energy. The political will to de-dollarize would surge overnight. But political will and practical infrastructure are two different things. Building an alternative to the dollar system is like trying to replace the entire road network of the world while traffic is still moving on it. Even if everyone agrees it should happen, the logistics are staggering. So here's the realistic picture. The dollar weakens, not in a single dramatic collapse, but in a slow, grinding erosion of confidence. Its share of global reserves, already down from roughly 70% in the early 2000s to somewhere around 58% today, falls further, faster. More trade gets done in other currencies. More central banks buy gold. The US loses some of the extraordinary privilege it has enjoyed for decades, the ability to print dollars and have the whole world accept them without question. The dollar doesn't disappear, but the era of unquestioned dollar dominance, the era where no one even seriously considered alternatives, that era ends. We've talked about the panic, the market crashes, the global contagion, the dollar losing its throne. But here's the thing I want you to actually sit with. Would the United States actually allow this to happen? Because a US default isn't like a company going bankrupt or a small country running out of foreign currency. The United States issues debt in its own currency. It prints dollars. It can technically always create the money needed to pay its bills. So a US default wouldn't be a financial inevitability. It would be a political choice. A failure of governance so spectacular that it would be, in a very real sense, self-inflicted. And every time Congress has come close, 2011, 2013, 2021, 2023, they blinked. Every single time. The debt ceiling got raised, the payments went out, the world exhaled. Because the people in power, whatever their ideology, understand something important. A real default doesn't just hurt their opponents, it hurts everyone. Their donors, their constituents, their own investment portfolios, their own political legacies. Nobody wins. So you get this strange annual theater. Politicians thundering about fiscal responsibility, markets getting nervous, headlines screaming about the deadline, emergency negotiations. And then, usually at the last possible moment, a deal. Always a deal. But here's what serious economists and strategists worry about. Not the default itself, but the erosion. Every time America plays this game, it sends a message to the world. Not the message Congress intends, about fiscal discipline or political leverage, but a different message entirely. The message that American debt is a political instrument, that it can be threatened, that the safety of US Treasuries depends not just on America's ability to pay, but on the willingness of 535 politicians to agree on something. That's a very different kind of risk than the world was pricing before. And the closer America keeps coming to the edge, the more extreme the brinkmanship gets, the more the world starts quietly, carefully, imperceptibly hedging its bets. What if someone miscalculates? What if the deal falls through for the first time? What if the global markets stop believing that the US always finds a way at the last minute? The moment the world stops believing, the whole calculation changes. And you don't need an actual default for that moment to arrive.